Ever wondered if your current trading strategies are truly effective? Maybe you're just getting started, or perhaps you're a seasoned trader in search of a fresh perspective. Regardless of where you stand, having a solid trading strategy is paramount. It's the backbone of successful trading, providing direction and purpose to your every move. In the world of trading, there's a myriad of strategies to choose from. But today, we'll focus on one that's been proven to stand the test of time: price action trading. It's an approach that revolves around the price and its movements, cutting through the noise and helping you make informed decisions. Over the next few minutes, we'll be exploring the 5 fundamentals of this powerful approach. We'll discuss how they work, when to use them, and the benefits they provide. So whether you're a novice or an expert, there's something new to learn and apply. Let's delve into these fundamentals and see how they can enhance your trading experience. First up, we have trend identification. Now, trend identification is like reading the pulse of the market. It's recognizing the rhythm, the pattern, and the general direction where the price is heading. Whether it's moving upwards, downwards, or sideways, being able to identify these trends is like having a compass in the vast ocean of trading. It provides you with a sense of direction, and it's absolutely vital to making informed trading decisions. So, how do you identify a trend, you might ask? Well, it's simpler than you might think. You see, trends are composed of higher highs and higher lows in an uptrend, and lower highs and lower lows in a downtrend. If the price is making higher highs and higher lows, well, that's a clear sign of an upward trend. On the contrary, if the price is making lower highs and lower lows, that's indicative of a downward trend. Now let's talk about sideways trends. These occur when there's a balance between buyers and sellers, neither gaining an upper hand. The price moves within a relatively stable range, making roughly equal highs and lows. These periods are often seen as consolidation phases before the price continues up or down. But why is trend identification so important? Well, trading with the trend, also known as trend following, is one of the most common and profitable strategies in trading. It's like paddling downstream in a river. You're going with the flow, not against it. By identifying the trend, you're aligning yourself with the market momentum, increasing your chances of successful trades. However, it's crucial to remember that trends aren't set in stone. They can and do change, often in response to new information or changes in market sentiment. So, always keep an eye on the market and be ready to adapt your strategy if the trend changes. One more thing, don't forget to consider the time frame. A trend that's apparent in a 1-hour chart might not be so clear in a daily chart. It's all about perspective. Mastering trend identification can significantly improve your trading strategy. So equip yourself with this vital skill and watch as your trading game elevates to new heights. Next, we have the concept of support and resistance. These are fundamental principles in price action trading, akin to the backbone of any healthy trading strategy. Imagine the market as a boxing ring. In one corner, we have the bulls, the buyers, who push the price upwards. In the other corner, we have the bears, the sellers, who drive the price downwards. Now picture a line in the sand, a point where the push and pull between these two competitors creates a visible barrier. That barrier, my friends, is what we call support and resistance. Support is like the floor beneath your feet. It's a price level where there's enough demand or buying interest to halt the downward pressure on the price. Think of it as a safety net where buyers come in strong, believing that the price is attractive and will go up from there. On the flip side, resistance is like the ceiling above your head. It's a price level where there's enough supply or selling interest to stop the price from climbing any further. Sellers believe that the price is too high and will likely drop from that point. Identifying these levels is more of an art than a science. You look at historical price data, find those points where the price has bounced back multiple times, and draw your lines. But remember, these aren't concrete walls. They're more like elastic bands that can stretch and even break with enough force. Why are these concepts crucial, you ask? Well, they provide valuable insight into the psychology of the market. They show you where the tug of war between buyers and sellers is most intense. And they serve as a map, guiding you to potential entry and exit points for your trades. For instance, a trader might buy at support, betting that the price will bounce back up, or they might sell at resistance, wagering that the price will retreat from that level. These are just examples, of course. Every trader has their own unique strategy. Understanding support and resistance can help you make well-informed trading decisions. They keep you in tune with the market's rhythm. And that, dear listeners, is a tune worth dancing to. Thirdly, let's discuss candlestick patterns. These are specific formations of one or more candlesticks on a chart, which traders use to predict future market movements. Why are they important, you ask? Well, they offer a visual representation of the fight between bulls and bears and can reveal potential reversals and continuations. Let's chew over some common examples. The doji pattern, for instance, shows indecision in the market as the opening and closing prices are virtually the same. When this appears at the end of a downtrend, it could signal a possible reversal. Then we have the bullish engulfing pattern, which occurs when a small red candle is followed by a large green one, engulfing it. This indicates that the bulls have taken control, and a potential uptrend may be on the horizon. See, the fascinating thing about candlestick patterns is how they tell a story. Recognizing candlestick patterns can give you valuable insights into market psychology. Our fourth fundamental is chart patterns. Chart patterns are like the puzzle pieces of the trading world. They provide a snapshot of the market, capturing its ebbs and flows, its highs and lows, its moments of calm and its moments of turbulence. But chart patterns aren't just pretty pictures. They're the visual representations of price movements over a set period, and they can give us insights into the psychology of the market. Now you might be thinking, what exactly does a chart pattern look like? Well, they come in many shapes and sizes. Some are as simple as a line connecting two or more price points. Others are more complex, forming shapes such as triangles, rectangles, and even the head and shoulders pattern. Each pattern tells a different story about the market. For example, let's consider the head and shoulders pattern. This pattern is often regarded as a reversal pattern, signaling a potential change in the market trend. It's characterized by a peak, followed by a higher peak, and then a lower peak, forming what looks like a head with two shoulders. When you spot this pattern, it could be an indication that the market trend is about to reverse from bullish to bearish. On the other hand, a triangle pattern, which forms when the price is consolidating, could indicate a continuation of the current trend or a reversal. It's like a pressure cooker, with the price bouncing between the support and resistance levels, building up tension until it finally breaks out. Understanding these chart patterns is crucial because they can help you anticipate potential market movements. They can provide hints about where the price might go next, giving you a chance to plan your trades accordingly. However, it's important to remember that chart patterns are not foolproof. They're tools to assist you in your trading decisions, but they can't predict the future with absolute certainty. Always use them in conjunction with other trading fundamentals and tools to increase your chances of success. Chart patterns can provide you with a broader view of market trends. Last but not least, we have volume. Now, what is volume? In simplest terms, it's the total number of shares or contracts traded in a security or market during a given period. It's like the heart rate monitor of the market, showing the intensity of trading activity. But why is it crucial? Well, volume can confirm the strength of a trend or signal a potential reversal. For instance, an increase in volume during an uptrend suggests that the trend is gaining momentum. Conversely, a sudden spike in volume during a downturn might indicate a bottoming out process, a potential turning point. So, how do you interpret volume in trading? Look for divergences between price and volume. If prices are rising and volume is increasing, that's a bullish sign. But if prices are rising and volume is decreasing, that could be a bearish divergence, a warning sign of an upcoming reversal. Remember, volume can offer you a deeper understanding of market activity. It's like having an additional sense to feel the pulse of the market. We've explored the 5 fundamentals of price action trading. Let's take a quick recap. Trend identification, the first fundamental, guides us through the market's direction, making it easier to ride the wave rather than swim against it. Support and resistance, our second fundamental, act as the market's safety nets, revealing potential points of entry and exit. The third fundamental, candlestick patterns, provides a visual snapshot of the market's mood, allowing us to predict the next move. Chart patterns, the fourth fundamental, are like the market's roadmap, guiding us towards high probability trades. Finally, volume, the fifth fundamental, is the heartbeat of the market, showing us the strength behind each move. These 5 fundamentals provide a comprehensive insight into the market's behavior, and when used wisely, they can significantly enhance your trading strategies. Remember, mastery comes with practice. So, continue honing these skills in your trading journey. With these fundamentals at your disposal, you're well on your way to becoming a more successful trader.